Many times, startups feel that equity is the only option they have for capital. Maybe because they've been to a bank and the banks have told them that they need 3 years of profitability or they need property collateral to get a loan. The good thing is that in the last 5 years, many new options have emerged that startups and clean tech companies can use as a source of working capital debt that goes beyond just a loan from a bank. I'll quickly talk about three of them. So the first one is invoice discounting, which is essentially when you sell your goods or your product, instead of your customer paying you after 2 to 3 months, the invoice discounter pays you the next day, so you have working capital available. The second option you have is a purchase order financing. It's basically when you get an order from a large customer, you need to pay for raw material, labor, contractors, and the lender can give you money for all of that. And once you deliver the product and your customer pays you, you repay the loan. The third option that you have as a clean tech company to go for a working capital debt is what's called a venture debt. This is a term loan or a line of credit offered by many impact funds that basically comes to you as a loan you can repay over 2 to 3 years as your revenues and profitability grows. I will not be overly optimistic and say that everybody can get a loan. There are certain things that all lenders look for all of these three products. They are looking for a strong founding team. They are looking for a business that is generating some revenue, which means that pre-revenue companies do not qualify for a loan. But as long as you can show the lenders that you have cash flows coming in, you have some growth potential and a strong business, you should be able to get a loan that meets your working capital requirements. Additionally, for invoice discounting or for PO-based funding, in fact, as well, lenders look for you selling to strong, large customers. Uh, for all of the products, lenders also want that you do not have any bad behaviors, like you don't have a default in the past, or you are not defaulting or delaying on your statutory dues or your GST. Um, as long as you can take care of all of these small compliance aspects, you can go to one of these lenders, show that your cash flows will be sufficient to repay the loan when it comes due, and you should be able to get invoice discounting or venture debt to meet your working capital requirements.